During the recent Fed-induced selling, gold managed to hold up quite well, while the silver market, in compliance with NSFR regulations, experienced a decline of over $2, effectively shaking out speculators. The spot gold market continues to show evidence of central bank and sovereign buying regardless of the price. The price itself doesn't matter to them, they are unconcerned. However, the paper markets may attempt to test key levels, which they have done and breached. Interestingly, it is the commercials who are taking the long side of this situation. They are closely examining the obligations to deliver against these paper prices. In a recent appearance on Live from the Vault, Andrew Maguire, a respected expert in precious metals and the founder of Goldmoney, shared his insights on the risks associated with rehypothecated gold. Rehypothecation involves the practice of lending out deposited gold to various parties simultaneously, using the same physical gold bars as collateral. Maguire emphasizes that this practice has become increasingly common in the gold market, raising concerns about the integrity and transparency of the system. During the interview, Andrew highlighted a concerning possibility: the potential shortage of physical gold compared to the claims made on it. This situation could turn disastrous if multiple parties simultaneously demand the return of their gold. Andrew's remarks shed light on a systemic risk within the gold market, emphasizing the urgent need for greater transparency and accountability to avoid a potential catastrophic scenario. Andrew also discussed the Federal Reserve's impact on the bullish prospects of gold. Surprisingly, the Fed's short position inadvertently contributes to pushing gold prices higher. This effect arises from the eventual necessity for the Fed to repurchase gold to close its position. The uncertainty surrounding the Federal Reserve's stance creates volatility in the gold market, making short-term predictions challenging. However, Andrew maintains a positive long-term outlook for gold, considering the Fed's position as a temporary setback. According to Andrew Maguire, there are actionable support levels that need to be considered. He suggests that for individuals who are stacking gold and silver, it is essential to convert depreciating fiat currencies into physical assets. This advice is not to be taken as trading guidance, but rather as a way to safeguard against the devaluation of currencies. Andrew Maguire also points out that the bullish performance of gold and silver in April can be attributed to underlying factors that have significantly influenced the market dynamics. He emphasizes the importance of analyzing these factors going forward. Furthermore, Andrew Maguire highlights the unprecedented accumulation of physical gold by central banks and sovereign entities over the past 15 months. He suggests that this accumulation has played a vital role in supporting the market and taking advantage of downturns in the paper market. According to Andrew Maguire, there are two major inflection points in the paper market that have bullish implications. The first one is the trapped Fed, which he believes deserves attention and further examination. According to Andrew Maguire, he mentioned in an interview that there are two crucial factors to consider. Firstly, there is a group of speculators who are embracing gold as a first-tier asset class, which has caught his attention. He describes this group as the mammoth in the room. Secondly, Maguire expressed his belief that the Federal Reserve is trapped in a self-induced rehypothecated gold hell, describing it as an extremely wrong-footed and kamikaze situation. Maguire claims that the Federal Reserve is the elephant in the room, exposed as the only global central bank that has failed to cover its bearish naked short positions on paper gold before the implementation of Basel III NSFR standards. This reclassification of gold as a Tier 1 asset on January 1 has left the Fed unable to hide its actions. As other central banks and sovereign entities rush to acquire physical gold, the Fed finds itself unable to cover its shorts, resulting in the current situation where speculators are selling and engaging in short sales. The question arises as to how the Fed will resolve this predicament. Maguire speculates whether the Fed will be forced to revalue its Treasury gold holdings for the third time in history, or resort to printing more money. He suggests that the solution lies in the revaluation of the dollar-denominated gold price, emphasizing that the price of gold itself has not changed, but rather the amount of fiat currency required to purchase the same ounce has increased. Maguire also points out that the Fed holds U.S. Treasury gold certificates rather than physical gold, which insulates them from political interference but keeps the true price of gold suppressed. Maguire believes that the Fed's revaluation of gold will have both positive and negative consequences. On the positive side, the revaluation will significantly increase the value of gold, aligning it with its actual worth. This, in turn, will attract more investor demand. However, he anticipates increased volatility in the gold market as a potential negative consequence. In terms of silver, Maguire suggests that a revaluation of gold at $6,000 per ounce would have a significant impact. He explains that silver, often viewed as an inflation hedge, would also experience an increase in price due to the rise in gold's value. Maguire suggests that the higher price of gold would make silver more appealing to investors, as an affordable entry into the precious metals market. Maguire concludes by highlighting historical trends, pointing out that gold's collateralization of U.S. foreign obligations has reached historic lows. He emphasizes the growing trend of Sino-Russian BRICS plus nations backing their currencies with gold and hard commodity baskets linked to gold, underscoring the significance of the situation. According to Andrew Maguire, one of the key objectives that Basel III was compelled to address is the need for the Federal Reserve to back the US dollar with gold, at least partially. Maguire believes that failure to do so will result in the eventual collapse of the US dollar. As other currencies are backed by gold, the value of the dollar would significantly depreciate in comparison. History has shown that unbacked fiat currencies have always crumbled against gold as the benchmark. Maguire asserts that the revaluation of dollar-denominated gold is crucial. Without it, the value of gold would be drained to zero. However, the lack of a proper audit raises concerns about how much of the 8,133 tons of unaudited Fed gold is physically available for delivery. Assuming the unaudited U.S. gold reserves are valid, the current ratio of gold to foreign debts outstanding stands at around 5%, which is far below the historical average of 20 to 40%. Based on the move to classify physical gold as a first-tier asset, Maguire suggests that the Bank for International Settlements expects this ratio to return to its historical average. Maguire questions the validity of the unaudited U.S. gold reserves, considering the possibility of rehypothecation and multiple ownership claims. This raises the potential for a haircut on the ratio, which could range from 0 to 5%. The lack of allowed audits raises further suspicion. Restoring the ratio to the historical average of 20 to 40% would imply a gold price ranging from $6,000 to $12,000 per ounce. However, Maguire points out that in 1980, when foreign-held treasuries of the U.S. government were 140% collateralized by gold, the gold price exceeded $40,000 per ounce in today's terms. Turning to silver, Maguire highlights the gold-silver cross ratio, which currently stands at over 80 to 1. Even without adjusting it to more realistic levels, this suggests a minimum silver price of $75 to $150 per ounce. However, as gold breaks free from unallocated claims, it is expected to trigger a short squeeze on silver, causing the historical 16 to 1 ratio to become influential. This implies a minimum silver price of $375 per ounce. These projections reflect the unique circumstances we are facing, where 50 years of paper gold dilution has reached a physical limit, and a genuine and fair gold price is set to emerge. Maguire concludes by emphasizing that gold and silver are often seen as hedges against inflation, as their prices tend to rise when the value of fiat currencies declines. These precious metals have been used as currency throughout history, lending to their status as reliable stores of value. As inflation persists, the potential for higher prices in the gold and silver market becomes more evident. A continuous rise in the price of gold could result in an increase in rehypothecation, where banks and financial institutions are inclined to lend out gold that is appreciating in worth. This trend raises questions about the future of rehypothecated gold and silver. We invite you to share your thoughts and observations in the comments section below. If you found this video informative, don't forget to give it a thumbs up, subscribe to our channel, and click the notification bell to receive updates on our latest content covering silver, gold, and copper. Thank you for being a part of our audience.